Thank you all for being here. It's 5 o'clock. Go ahead and start the Human Resource Insurance Committee meeting. Jody, if you take the roll.
Stinnett? Here. Merle? Here. Farmer? Here. Chris? Here. Caskey? Here. Kaler? Here. Dunlap? Here. Barone? Mitchell? Here. Lewis?
Here.
You have a quorum.
Thank you. At this time, John, if you would play the emergency announcement, please.
Before we get started, let me read the emergency evacuation procedures. In the event of an emergency evacuation, an alarm will sound. Everyone should exit the building by way of the nearest stairwell in a safe and effective manner. If the nearest stairwell is blocked by smoke, use the other stairwell. Do not use the elevator. Once you've reached the main floor, follow the exit signs to exit the building and quickly proceed away from the building. Please be mindful of others evacuating and of emergency vehicles.
Okay, item on the agenda is input on items on the agenda. Is there anyone who would like to address any items on the agenda? Okay, seeing none. Should have a copy and emailed a copy of the minutes of the May 19 meeting. Those are in your packet. I'd take a motion for approval of those minutes. Motion and a second. Commissioner Caskey, thank you. Any further discussion? You need a voice vote? Okay. All those in favor say aye. Aye. Any opposed? Next item on the agenda is discussion regarding the health fund. We had a call just a few minutes ago from our insurance, Cole Harris, who was stuck in a little bit of traffic, but was there. He is, was almost here. Perfect timing, Cole. You don't even have to sit down. Yeah. Jenny, you want to preface that in any way? Yeah, you should have the billing.
Okay. Yeah, just to, before Cole gives us the update, I wanted to provide you with the monthly revenue and expenditures that we did this last month for April, and we have the May numbers this month as well. So in the month of May, we brought in $1,526,904.55 in revenue. Our expenditures were $104,866.35, which gave us a deficit of $577,961.80 for the month. Year to date, this is fiscal year, so from July 1 of 14 to May 31 of 15, our revenue is $15,770,073.43. Expenditures are $18,296,628.04, which leaves us with a deficit of $2,526,554.61. And then now Cole has some general updates for us as well.
There we go.
Did you come on?
That's because I didn't flip that. There you go.
Okay. Want to apologize for being a few moments behind. Today, I'm going to go over just some brief general overview information. As we mentioned a few months ago, I think the idea behind these meetings and being more often and frequent is to just give you more information. As I also mentioned during the first HR committee meeting where I spoke, we really expect July the July meeting to be the one where we're going to make recommendations and to be able to really share with you everything that we've pulled together. We are in the final phases of being able to gather all of the information that we've marketed, and so far we've got some good data. So I don't want you to feel like the wheels are completely falling off, because we do have some good alternative solutions that I think is going to really help out the county from a cost savings measure, as well as for future emphases. We've gone to market, as I mentioned the last time, we've gone to market on your pharmacy benefit, your ASO, which is your administrative only, which also is considered your Humana benefit, your dental insurance, your life insurance, long-term disability, short-term disability, those products, the long-term disability and those products are considered voluntary products, which means the employee pays the entire cost currently. So the main parts that are going to be a driver to the county are going to be the dental, the life insurance, the ASO, the pharmacy, and the stop loss. So when we go through those processes, the ASO, for instance, right now is bundled. So what that means is that your pharmacy benefit and your administrative services are all with Humana. So through that process, we actually go out and seek other providers, such as like United Healthcare, which is considered a UMR, or Cigna, or Blue Cross, and we not only look at the fixed cost, which is going to be your per employee per month cost that charges for the administrative claims. We also want to know how is it going to affect your claims whenever you go to the doctor, and how much the doctor charges to a Humana or a Blue Cross or a Cigna. So there is a whole lot involved with that claims process. We want to know, based on your claims for the last 12 months, how would it have affected Blount County from a cost perspective if you were with a Cigna or an Aetna or someone else. So when we do go through the final recommendations, that will all be taken into consideration. Same with the pharmacy. And the pharmacy we have some really good data on, and I believe we'll be able to have some cost savings there. Also, as a high-level update, the stop loss we should be finalizing here shortly for July 1. We've got, as I originally mentioned, the original renewal was at 45%. We are now down to around the 25%, so we've knocked out 20%. And then with increasing it to on the stop loss, and this just means how much claims are going to be paid. Stop loss doesn't affect the employee at all. This is just behind the scenes funding type of mechanisms, and insurance on insurance is basically how it's looked at. With making a few tweaks, we can get it to where the cost to Blount County is either very minimal, if not even equal to where you were at before. So I think we've done a lot of really good work in that side of it to help out. Jenny, do you know, is this information? Okay, perfect. So this is some information that we put together for this meeting. This is 3 years worth of data. So the first page is going to be, is going to be the number of employees. So this data is probably the most important part about everything, because the data of just looking at claims means nothing if you don't look at the story behind it. And really, whenever you're looking at this data, you have to consider this is only a small piece of the overall pie. You have your cost with your claims, but then you also have your cost with your stop loss, your cost with the administrative services, your cost with the clinic that you have, as well as your cost with the EAP. So there's a lot of other pieces that this isn't showing, but we're focusing more on the claim side. So if you look at the lines, your blue line is going to be your 2012. You'll see in 2012, your number of employees were actually quite a bit higher than any other year. 2013, it dipped a little bit lower. 2014, it went even lower. Your 2015, you're trending about where you were towards the end of 2014. So you had a dip in the middle of the year, which this is consistent. You also are going to have another dip this year. A lot of it, as I'm sure you're aware, is probably tied more towards the school board with the end of the year, the school season, and then that picks back up at the beginning of the school season. So you're always going to have that dip. Our office just spent 4 hours today processing those terminations for this upcoming one and the COBRA notices. So we're very familiar with that dip, as I'm sure you are. And now, as we expect, rise back up. But why that's important is when we look at the claims on the next page, you'll see 2012, your claims were also higher. over. Go ahead.
Question. Can I answer your question as you go? One question. Okay. You've got employees,
Correct.
but that's a small amount of, in relationship of dependents. Do we not need the dependents?
No, this is, it may be a terminology thing here, but whenever I say employees, this is going to consider subscribers. So this is total number of bodies that are enrolled in your plan as far as from an employee standpoint.
But we're insuring 4,000 people.
Correct, but whenever you have an employee come off, then yeah, that's going to have the family and everything else. But if you look at overall dependents don't fluctuate tied to months of the year like your employee does. So when you're looking at a forecasting, even overall dependents, if your employee count goes down by 20%, then your dependents statistically will typically follow by 20%. So when you're doing it from a comparison standpoint, I can include the dependents, but you're going to see no difference in the way that you're correlating the data, because the whole purpose for this is to just show that in 2012 you had a lot more members than in 2014 or 15.
Okay. Second question. That dip, you say at schools? We're laying people off, or what are we doing?
The school year ends in May, so typically when
It's what?
whenever the school year ends in May, you're typically going to have lower employees then from May until whenever the school year pops back up in August. So.
What happens on that, I don't know if everyone needs to hear this, but when we have people that resign, retire, they usually drop off our payroll sometime in June, or insurance rolls sometime in June. And then our new hires who start late July, their insurance starts 30 days after that. So August, you have a big spike. So that's where you have some drop off and then some go up.
Do we not, I thought our guys people who retired from our school system stayed on our insurance.
They do, but this is resignations too. We have people that leave the school system. I mean, without looking at exact names, but that would be why the trend occurs that way. So.
9 people. Okay, thank you.
Yep. Okay. So then when we get to the medical claims, you'll see the similar spikes. So that trend line is going to follow your employee count. Your 2012, your medical is going to be higher. You're also going to see different spikes and variations just due to whenever claims are paid versus incurred, as well as you're going to have various outliers. So if you have someone that has a major medical condition one month, it's really going to spike your claims versus the other. But overall, for the trend, you're going to see that 2012 trended higher than the other years because it was also a higher enrollment count. 2013, it dropped down. I believe that was, to my knowledge, from a contribution change where employees started having to pay a portion of the cost, and then enrollment dropped from that, as would be expected. A lot of times, and we find this in the private sector as well, is whenever you have employees that don't have any cost to it, you'll see a lot of double coverage because they don't have to pay for it, so they're automatically going to take it. Whereas if they have any amount of cost whatsoever, they'll see that there is no need for the double coverage and pull off of the plan. And so we've seen that historically. Ever since the days of the HMOs going away, there really isn't much of a benefit for coordination of coverage. And so whenever that perception is gone and there's a financial impact, the enrollment tends to go down with that. 2014, the claims costs started to pick up a little bit more. And in 2015, as what Jenny mentioned in the beginning, with your update on the financial status of the fund, it's trending quite a bit higher than in the previous years.
Cole,
So, go
can
ahead.
you talk just a second about, because I think that the 2015 claims numbers jump out a little bit simply because if you look at number of employees, which is less, you said about the 2000 and close to the 2014 level. However, if you look at 2015 claims with less people, they're well above what they were in any of those years up to that date. So can you talk about that just a little bit?
Yeah, without diving too much into the data on that part, what I can gather from the trend line is you'll notice that in January and February, the claims were actually specifically January, the claims were lower. And so that tells me that it's catching up from a claims processing standpoint. Whenever your renewal is January, like it is currently, and you make any kind of changes, and you didn't make necessarily benefit policy changes, but there's just changes administratively within Humana, and just with the renewal being processed, they generally will hold the claims a little bit longer than they normally will. So claims get paid later than they would. So you'll typically see, just like in the previous months, January might be a lower claims paying month, but then they make up for it due to the double side of it. I do anticipate that claims line will slow down a little bit. You also had a couple of very, very high claimants the past couple months in the form of premature babies. So whenever those occur, your claims can be getting up into the $1 million range, where you're going to have stop loss pick up after the $250,000, but stop loss works on a reimbursement type of situation. So you have to have the claims completely processed and paid for prior to stop loss coming up for it. Unfortunately, claims data that gets sent out is not going to account for stop loss that it comes back. So these are actually incurred paid claims. Since the stop loss is a completely separate entity than your health insurance. So I would say the two premiums probably and some of those outlier claims that you didn't have in the past is going to greatly affect that claims drop. But that's also why we see that claims, I anticipate over the next 4 or 5 months, I believe you'll see that claim trend line kind of dip down and get more normalized than what it is in the past couple.
Yeah, because I noticed from January to February, whereas in previous years, those claims have trended downward, that in January, February this year, those same claims have trended upward and kind of continued that.
Yeah, and then you'll see that from like February to March, there's that big spike. So it's just a difference, I think, in the way that the administrator was holding back some claims and then paying it at that point. But that combined with the high claimants that you incurred this year that you hadn't had in the previous years. You've had high claimants, but not necessarily to this degree.
Which I guess also starts to help explain the difference in the gap between revenue and expense.
Absolutely. So you might find that some of that gap will be refunded back in the next couple of months as stop loss pays out, but that also could be more on the speculation side, without getting into the specific of that.
Mr. Harris.
Mr. Chairman.
Question. I want to make sure I understand what you said. If we have a $400,000 claim, we have to pay that, but then eventually we get the $150 back.
Correct.
But we have to pay it up front.
Correct.
Okay.
Yeah, and that's where you'll see on your fund balances, whenever you go through the budgetary process, you'll see that accounted for during that.
Thank you. How much is owed in stop loss right now?
I would have to get a more recent report. I'm not quite sure how much has been paid out to date up to this meeting, but I'd have to see. Do you know? Have you seen anything on it? Okay, I'll have to check on that.
We don't know how much we're owed now. We don't know what the timeline is for getting reimbursed for it.
It all depends on, you have multiple different factors. It's not as simple as just a one solution. You have the works of the physician filing the claim. Then you have the period of Blount County paying the claim, and then also the period of Humana processing that payment and sending it on to the physician. And then you also have the last piece of it, which is the stop loss vendor getting all that data and then processing that claim to get reimbursed. And then also when they mail the checks. So you have many variables in there. It's not as simple as, well, the claim occurred, we're automatically going to get a check back. So they'll mail those checks just in certain periods during the month and the week. So,
Quite frankly, that would be important information for us to have.
And it changes on a quite frequent basis.
Well, you've gone back the past 6 months, and I agree with you. I've gone back past 6 months too. I've gone back past 2 years. And if you go back past the past 6 years, it's pretty, I mean, it's up and down. But yeah, the past 6 months have been some high claims.
There have been. And
But
you
you
also
can't
see
base
that.
the future on 6-month time period.
No, but you'll see here soon, Commissioner Caskey, in the next 2 pages, when we get to the fund balance, claims are one thing, but when your fund balance is decreasing, there's more to it than just the claims. And this is the historical data of not just 6 months, this is over a 2-3 year period of time. Your fund balance back in 2012 was at $6 million. As of Jenny's update, you said it was, what, $2.5 million. So in just a period of 3 years, it's dropped by more than half. And that's where the problem is.
Thank you, Mr. Chairman. This really isn't for you, and I apologize, but on the stuff we have, we've got the claims, we've got the number of employees. What we don't have is the revenue. There is nothing on anything we have indicating the revenue. Now, a couple of years ago, we made a change to increase revenue. It's not reflected anywhere on here. According to the fund balance drop, we're sort of going on a steady downward slope. When we made the changes a couple of years ago, we should have had a variation in that. It's not reflected.
I have the revenue, and is that Shannon Mountain? Okay.
Well, it's a little bit hard to tell what we're talking about intelligently if we don't have the revenue.
Yeah,
the revenue should have changed between 2012 and 2015.
And in looking at the revenue, and I can share this with you. I don't know if I can hand. Okay.
Well, I mean, just tell me.
Okay. I can give you an example. In July of 2012, your revenue is $1.99 million. Another one in 2012 would be December of 2012 November 2012, which is a more normal month, was $1.5 million. To fast forward, so that was July and November. So in July of 2013, your revenue, well, that was a bad month, that was $777. In June of 2013, your revenue was $1.8 million. In November of 2013, it was $1.4 million. And
okay, that's what I'm getting at, because the numbers you're giving me, we shouldn't be decreasing on fund balance. We should have been increasing. June of 2013, expenditures 1.3 million. You just told me 1.8 in revenue. How do you decrease fund balance on that?
yeah, when you look at and that's where I hate using the claims data, is just your sold data, because this is going to be the Humana data of what has been incurred. So you're paid from a month-to-month basis. You can't compare it. You have to look at it over a period of like a quarter.
I understand big picture.
Yeah, and then also you have the other factors that are in your fund balance. That would be like your stop-loss premiums, which will account for $50,000 or $60,000. You have your on-site clinic premiums and cost. You have your EAP, as well as the costs around the claims with the EAP. So everything is bundled into this, not just the claims.
Okay, and you just, for instance, July of 2012, I think you said 1.99.
Yeah, but on that same note, the reason why I didn't say June of, let's say like on July of 2013, it was $777,000 for the revenues. The reason for that is just, you'll see in June of 2013 is 1.8, in July is 777, and August is 1.3 million. The reason for that is it's all based on the timing of when the monies are going to be accounted for, I'd presume. So, and the same thing with claims. So it's hard to compare just 1 month to 1 month whenever you have, obviously you didn't bring in the 777 in 1 month, and you probably didn't bring in 1.8, but over a 2-month period of time, that's probably how that works.
Oh, okay, and I'll apologize. I don't mean to keep rambling on. However, let's use April of 2015. Expenditures 1.8.
Yeah, and revenues at 1.5.
I don't understand how we have less revenues when we made the changes a couple of years ago when we're close to the same number of employees.
Yeah.
That's where I'm lost on something.
Unfortunately, I wouldn't be able to comment on that part. as far as where the revenues, as far as that part of it.
Thank you.
Randy, would you have any information on the accounting side of that as to how those revenues are booked every month from the healthcare side? And why there'd be fluctuations in that revenue on a month-to-month basis?
Well, the pieces will be, we've got revenue coming into the fund from premiums that are charged on the employees out of each of their departments. The other revenue stream into that fund would be the contributions that employees are making through their payroll deductions. And then the third string of revenue on premiums would come from the retirees. Have I left anything out, Jenny?
Cobra.
And then, Cobra, sure, a few of those. But
And
those
when-
would be the 4 premium revenue streams coming in.
And when the stop-loss money comes in, does it also flow in as a revenue item? And then
No, it flows in as a contra expense because it is a reduction of the cost of the claim. So some of the timing might be you incur a claim of $400,000 that was mentioned earlier. That may stay on the books as an expense for a period of time until the stop loss comes in. Then when we get a check for, say, $150,000, we reduce claims by that $150,000 so that the net cost of that claim is $250,000.
So some of that revenue variance would be depending on how pay periods fall?
How pay periods fall for the premiums on employees, and then the stop loss, you're just at whatever mercy that you get the check in for reimbursement.
Okay, thank you. Commissioner Stinnett?
Yes. Cole, question. Stop loss as of today, do we have any idea what they owe us?
What they owe us, the last claim that I saw on the stop loss of the high claimant was close to $1.2 million. So if the part though is that's going to be completely unsubstantiated. So that's the claim as it sits right now. There has to go through network discounts and everything else that goes through it. So it could be anywhere from, $800,000 down to $100,000. It all depends on how it's processed and paid for.
It's stop loss,
That's
so that's not part of this.
this is all part of Humana data. This isn't going to be the stop loss data included in with this. So this is just purely claims.
Going back to what Commissioner Farmer said, it would help us if we had on these lines that income revenue, because at the end of 3 years, we should be able to come over here and add and subtract and show us, so we have no question about where we're at.
Yes. So for the next July meeting, that will be part of.
We understand not week by month, you couldn't do it, but
Yeah.
if you go across 3 years of information, there should be a total there.
Yeah.
That would help me, sir.
Yeah. And there's that piece, but then you get into a lot of other factors too that will still affect it, such as the on-site clinic, the EAP and all of that. And there's, so that is part of it. And that all can kind of reduce what your revenues are that go in.
Our clinic, we pay per visit?
The clinic is going to be a per employee and a per member per month basis on the clinic side.
Right.
And then the
That was my
EAP,
point.
the EAP, there is a per visit cost. So there's your per employee cost, and then you also have a consultation cost for every time it's used.
Right. What encouragement do we have for people to use that clinic?
For the clinic, I don't have access to that data. For the EAP, it varies monthly. So.
What encouragement do we have for members to use the clinic versus going to the doctor?
We encourage them at any point whenever they come to Jody or myself,
Mm-hmm.
you know, initially when we have a new hire and we go through their orientation with the benefits, we encourage them or, you know, to go to the clinic first because it is at no cost to the employee before they, you know, go to another doctor or anything along those lines. We encourage them to go to the clinic first.
There's a large financial incentive to the employee to go to the clinic versus a normal
Absolutely.
doctor.
We might want to give them $20 to show up.
Serious.
It's cheap.
Commissioner Farmer?
Just a couple of things. What he's saying is the changes we made, you can look at your fund balance and see where we shot back up part of the way. And we sort of got to a break-even point and we were running good for a while. Then all of a sudden we start dropping off the scale again. That's sort of why I was asking about the revenue. If we have the revenue to go along with it, then you can see that. If we don't, then yeah, we can look and see the claims, but it's difficult. So if that could be included with it, it would sure make it a lot easier on us. And as far as encouragement to go to the clinic, pat them on the head, do anything, because it saves them money out of their pocket and it saves us money.
Yeah, we make sure that they understand it. It's going to save them their, you know, cost towards their deductible. They're not having to pay that, so we do go over that.
Yeah, there's no copay for the doctor visit. So if the employee goes someone outside of the clinic and a normal doctor visit $120, they're going to spend $120 for that doctor visit versus the clinic of nothing. So.
And I think Commissioner Stinnett is at least alluding to the wellness initiative. And do we currently have one in place to encourage folks to do that?
That's not There's no the wellness. No, we don't have. I think there's been something in the past that has been done that some people are still doing, but it's not an active wellness program like what we need that we are working with Cole's team on to get in place.
Okay.
Yeah, we're working. That it's on the agenda.
Okay. Thank you.
Yep. So, as far as whenever you look at the next graph, you will see the medical and pharmacy combined, and that's going to be obviously a little bit better of a picture. The things that you have on the pharmacy side, and this is going to impact you even greater over the next year, are going to be the specialty drugs. You may have seen them in the news. You had the hepatitis C drugs that came out last year. Those were $30,000 per treatment and they generally take 3 treatments for those, and I believe you all had a few people that had to take that. That came out last year. So yeah, 3 people that had that. So over 3 people, you're looking at over $200,000 just in pharmacy claims. And unfortunately, that's typically not going to hit the specifics. So that's just money that comes straight out of Blount County. This upcoming year, you're going to have a high cholesterol medicine that's going to be approved in the market. We're anticipating by third quarter. Or by fourth quarter, I'm sorry. And the high cholesterol medicine is, the dangerous part about it is it only costs $600 a month, and it's sad to say only. But with it being a high cholesterol medicine, there's hundreds of millions of people affected by high cholesterol, where there's a far fewer population for the hepatitis C. So we're expecting that to have a much greater impact. So unfortunately, we're not going to see our drug claims per se on the high cost dollar drugs go down. But what we can do is better manage it through pharmacy management as well as through plan design. And that's what our goal is through this process. With the pharmacy management, I think we're on a clear path as opposed to where you're currently at. So for that piece of it. And we've gotten into the bar chart is just going to be the medical and RX claims annualized, just so you can see how that looks for that piece of it. And again, keep in mind that 2015, we had fewer enrollment than in 2012. Then the last part we've already hit on quite a bit was going to be the fund balance. And the fund balance, the trend line, you can see the linear line is going to be your forecasted line based on the data since 2012. And you have had more of a severe loss over the last couple months. Hopefully that will level off more as claims exceeded the $250,000 spec and it starts to be reimbursed towards the third quarter. Also, we expect that your claims will go down with the drop in enrollment from the attrition on the school board side for June. But again, keep in mind it will probably pick back up whenever the enrollment pops back up. Also expect towards the end of the year when people have typically met their deductibles and out-of-pockets that usually claims will go up, trending towards the end of the year as well from those pieces. My next steps, and this is what I hope to have for you, or will have for you by July, is going to be I'll have a full market analysis from all the different vendors, and then also be able to show you based on actuarial data how things will look if, let's say that we end up moving from Humana to another vendor on the ASO side from a network standpoint. First of all, how would claims look if you were with that vendor for the last 12 months? So what kind of discounting would that affect it? But then also if we add to your current portfolio of options, you have one option right now, which is an incredibly rich plan option, $500 deductible, $1,500 out of pocket. It looks like that $1,500 out of pocket is accumulated through your both tiers of the network, but it looks like it's also the family out of pocket. So it's a very, very, very rich plan. But also adding to that of some options that could keep employees' costs down as well as create more of a consumerism environment, just like what you might find on the state plan or other area municipalities, and make it and be able to show you from an actuarial standpoint how we expect that to affect your claims costs. Between that, the pharmacy, the wellness, and the stop loss, we'll have a full overview picture that's going to be a plethora of information for you to debate and talk through. But this is fairly general for today's session.
Could we have this information in a few days before the meeting so we can look at it?
Yeah. Yeah. Yeah, that's fine.
Yeah, and what we'll try to do is, as this information comes in from Cole and from CBIZ, as we receive that, we will also email that out to the committee members so that we won't come back here in July and you all be looking at information for the first time. We will forward that information to you as it comes in over the next 30 days.
So as it comes in. Yeah.
Any other questions for Cole?
Mr. Chairman, I know these charts are pretty and all this stuff. I would like to have numbers. And I think we asked for a monthly report and we didn't receive a monthly report. I know that Ms. Morgan gave us the information for the month. Could we get that also in a hard copy? Would that be possible? Thank you.
Yep. And I may have misunderstood Commissioner Caskey. I knew we wanted the numbers in here every month for revenue and expense. Didn't know that we wanted those hard numbers, but we can certainly get those. Yeah.
Keep in mind, a lot of times the numbers, I don't know how far in advance, like the claims numbers will be able to get to you just because we have to wait to get all of that from Humana. But, I mean, so it may be the day before. Sometimes that's why I didn't have it. We were waiting to get all the final stuff in for the month of May. So it does take until about halfway through the next month before you completely finalize the month before. So just keep that in mind that we may be a little delayed with those, but we'll definitely get them to you.
Yeah, I would think there'd be at least a 2-week lag between the end of the month and the time that information would be available.
Yeah, the 15th is typical. So they generally don't even generate reports for the prior month until the 15th after.
Good deal. Any other questions, comments for Cole? All right. Thank you, Cole.
All right, thank you.
Oh. Yeah, Cole, you may want to come on back. You're next on the agenda as well. Information regarding stop-loss carriers.
Okay. Thank you for having me today. Okay. I was hoping today to be able to tell you this is who we're going with. As of yesterday, a company called HCC Life, which is a very top-notch stop-loss vendor. You're currently with HM Life, so they're both very strong partners of all the major carriers. So your current of HM Life as of yesterday was still at a 45% increase. HCC Life for the $300,000 specific loss came in at an 8% increase over your current. So instead of a 45% increase, it was an 8%. And for the $250,000 spec, it was coming in around a 30% increase over current as opposed to the 45. The negative with the $250,000 spec, and I'm sorry for the insurance jargon, but is that HCC would place between 3 to 5 lasers if you're to do a $250,000. So what that means is that they would say that we're not going to cover claims for that person until they've exceeded $350,000 for those 3 to 5 individuals. So you'd be paying for something that you wouldn't get the benefit for. So for the lower premiums, as well as they're saying they would not do any lasers for the $300,000, then our recommendation as of yesterday was to go with a $300,000 specific with HCC at an 8% increase over current. As of around 10 o'clock this morning, we received a last email, of course, since they were aware that we're having this meeting tonight, from HM Life, which is your current vendor, stating that they are reducing the renewal from 45% down to 25%, and your $300,000 specific is actually lower than your current. So instead of being an 8% increase, it's going to be slightly lower. So being in sales, I was sure to share that information to HCC. So before providing a recommendation, I'm told from HCC they had to send it up to their head underwriter and corporate to see if they can come down even further from their existing quote, and I'm told I'll know that tomorrow from that amount. So if they do come back, obviously they're not going to come back higher than HM and expect to win your business. So I would expect it to be lower than current. So there's at a $300,000 specific, we could anticipate that you have a reduction in premiums over current.
So our option, or the thing we would need to look at that point is how much we think we would have to pay out of pocket on those claims for more than $300,000.
Exactly. So what I look at when I view it is, one, are there going to be lasers on a $250,000 versus a $300,000? And then two, what is the break-even point? So if our break-even is 2, and we know that the last 3 or 4 years you've had at least 2 people exceed their $250,000 spec, then we know that it doesn't make sense to have the premium savings for the reduced stop-loss benefit. So our goal would be to have a 4-person break-even, but even at the 3, you start to wonder if it makes sense or not. So if we're at 4 and we'll be able to compare those numbers, then it would definitely probably make sense to go to the 300, since over the last 3 years, you haven't had 4 people exceed the $250,000 spec.
So our risk or our gap is the exposure between the $250,000 and $300,000 before that insurance would kick in.
Exactly.
Okay.
Yeah. And again, I believe I mentioned this in the first meeting, but over the past few years, and I said that exact number the last time, over the last few years, your premiums that were paid in on the stop loss were less than the claims that were paid out. So that's the reason for the 45% increase, the initial 45% increase. So I believe off of memory, I believe your loss ratio is 150%, meaning that for every dollar you spent in premium, they paid out $1.50 in claims. So. But that's also where I see the encouragement of your claims trending more level, because they were able to come down off of that renewal based on, as Jenny mentioned, the last month's data, since that was just released yesterday. That was sent, and then they quickly turned it around from 45% down to 25%.
Commissioner Farmer?
Just keep shopping.
Yeah. Yeah. I showed someone our folder of all the vendors that we've looked at. We're currently, amongst all of the products, with the stop loss, we looked at 12 different carriers. Unfortunately, all but HCC declined to quote. But HCC is getting very competitive, so we'll continue to fight with them and not accept it until we think it's the very end of it. For perspective purposes, the disability life insurance side of it, we marketed out to 22 vendors. So we will have a very accurate depiction of what the market plays out for you all, and there is some competitiveness in certain segments.
Okay. Any other questions?
We should have one last point to it. I think this is encouraging. It's a little bit different. Is your worksite products, which are going to be your voluntary products that are always marketed, which would be like your cancer products and those types of things. In the past, that had no benefit to the county. It's an employee benefit and a good benefit for them. They pay it out. It doesn't cost the county anything. We were able to negotiate in to where we do anticipate that there will be an incentive, a financial savings to the county by being able to place some of those products with some different vendors. So there's some creative things that we can do to offset for other costs, such as your Courthouse and other things with that. So
We need some good news.
yeah, so I think it will be a much better meeting next month. So,
All right.
all right,
Thank you, Cole.
thank you.
Oh, is anybody else? Okay. Okay. Is there anyone who would like to comment on input on items not on the agenda? Okay, we'll just remind this group, our next meeting is July the 21st. And if there's no objection, we will adjourn.